Hey everyone, Bill Constane, Freedom Wealth TV, and welcome to our next episode. We're going to talk about the stock market today. Some fears out there in the marketplace, and I just want to give you some update. I'm going to include a short 2-minute video of some of the experts, what they're saying, what the world is doing, and you can evaluate if this is the beginning of a market correction, a market crash, or if this is just an overreaction. Love to see a thumbs up, a comment in this particular. Hey everyone, Bill Constane, Freedom Wealth TV, and welcome to our next episode. We're going to be talking about the stock market, the Dow Jones, the NASDAQ, the S&P 500, how it's impacting investors around the world. We're going to include about a 2-minute video, and you're going to hear about some experts and what they say is going on in the marketplace and what to expect. Make sure you listen to the very end. I'm going to give you some solutions that some smart investors are doing to diversify and to protect their money. So if you enjoy the content, please give us a thumbs up, a positive comment. The comment I want to see today is, do you think the market is overreacting to what's going on? Do you think that it is the beginning of a market correction, a market crash? Tell me what you think in the comments below. And of course, as always, subscribe if you haven't already. Hit the notification bell. All right, let's get cracking. Dow plunges 1,000 points on the coronavirus fears. 3.5% down today. The drop is the worst in 2 years. So we've had a great market. I've been warning people that I think the end of this bull market is about to end if it hasn't ended already. So let's see what's going on. I'm going to play a video here in just a moment. The Dow drops more than 900, actually more than 1,000 points at the close. So let's see what's going on right now.
We're going to sit back. The market is finally reacting to the risk of the virus, something that I was surprised last week when we hit record highs. We don't even know the full measure of it yet, obviously. The fact that cases are dropping in China is a good sign, but when they open up their economy and people travel, that's going to probably increase the number of cases. So you've got to think long term, and you've got to back away from a day like today and not just react. Don't think in 91-day increments, but think more in decades like Warren Buffett does.
There's a lot of good things going on beyond the immediate news, and that is the improvement in tone in terms of the overall global economy. There was a lot of pump priming from central banks over the last year or so. There has been a drawdown in inventories around the world, and that could lead to a more sustained pickup this year. Unfortunately, right at the moment where you would be looking for that pickup to start to get some real lift, we've been hit with this coronavirus, which does have some real impacts. There are very significant supply chains in China, and when you look at the IHS market services survey from last week, it was a very large drop here in the United States. So we're weighing the bigger picture, which is one that is, we think, going to move towards a improved economy later this year. But we have the near-term challenge and uncertainty surrounding coronavirus and the spread of that virus, which has significant impacts as we see today in the near term.
We've gone over 6 months without a normal correction. You layer on the coronavirus, which provides more uncertainty, and we think the risk-reward near term remains mixed on it. So from our perspective, what does that mean? That means maybe bringing equity allocations that have run up quite a bit back to targets, maybe a little bit of cash. In some of our more tactical portfolios, late last year, we added a little bit of gold. I just want to say, longer term, we still think the bull market trend is intact. But when you shut down the second largest economy in the world, that's going to have some impact.
All right. So what did you think about that? Just 3 guys, 3 experts in the field, different opinions, of course. So time will tell. No one's a fortune teller. I don't believe in fortune tellers necessarily either. So anyways, I'm going to give you the rest of the report here. I'm going to give you some solutions on how to guarantee that you can participate in the upside of the market, but none of the downside. And that's what I've been doing now for over 20 years and over 25 years in the financial markets. I feel very blessed that I can help clients really have peace of mind. So people are stressed. I'm not stressed at all because my money's protected, my clients' money's protected. It's like an umbrella over these investments. Now, the Dow Jones closed 1,031 points lower, 3.56% to 29,960. The S&P 500 slid 3.35% to 3225, while the Nasdaq closed 3.71. This is one day, folks, in one day. Now, for people that are in their 20s and 30s, maybe 40s, you might not care so much because you have many years to recover. But people that are in their 40s, 50s, 60s, 70s, 80s, certainly 90s, that impacts retirement income. If you take an income out plus the market is coming down, it can be a little concerning. So the second largest economy in the world is completely shut down. People aren't totally pricing that in, said Larry Benedict, CEO of the Opportunistic Trader, adding a 10 to 15% correction in stocks may be starting. So this may be the start, he says. He also says some parts of the market, particularly large cap tech stocks, appear to be over-owned. It seems like there's much more to come. Okay, coronavirus impacted names led the way lower. Airline stocks, Delta and American were both down more than 6%, while United closed 5.4% in one day. Shares of casino operators, Las Vegas Sands, Wynn Resorts dropped 5.2% each. The Chinese are not coming over, impacts the economy. I said this early on, and I think we're going to start to feel that impact because people are being overly optimistic. I think a lot of the smaller players, the smaller businesses are not going to be able to sustain this for 2, 3, 4, 5 months. And I think we're going to see a lot of companies, unfortunately, go out of business, which can impact some of the bigger companies. So chip makers, which are highly leveraged to the global economy, were also down broadly. NVIDIA shares were down 7.1% in one day, while Dow Component Intel ended the day down 4%. AMD dipped 7.8%, and so on. The Dow's biggest one-day drops, take a look at this. This is the third biggest drop in the past 3 years, 1,031. Okay, so the market has been sanguine about the spread of the coronavirus, said Quincy Crosby, chief market strategist at Prudential Financial. That stance is being tested today. I'm going to give you a definition in the description. Companies are assessing their suppliers and their supply chains and seeing whether or not their revenue is going to slow. Apple and the suppliers took a hit as well. Apple even got hit, 4.8% in one day. Overseas markets fell sharply. Legendary investor Warren Buffett said the coronavirus spread has softened up the U.S. economy, but noted growth is still healthy. What else is he going to say? If he didn't say that, the market would have been down 25%. I mean, if you get people like that saying the market's going down, watch out. All right, there remains a large degree of uncertainty. The major averages hit records high. In the earlier days after the outbreak, many economists have predicted a V-shaped recovery. All right, the benchmark 10-year note yield fell to 1.36%. Simply put, the markets were not set up for where we are today, said Gregory Farinello, head of U.S. rates trading at Amerivet Securities. And I think that's about it. So there's your article, ladies and gentlemen. What do you think? What do you think the market's going to be? Was that an overreaction? Are we just going to pop back up here? Is this just the beginning of maybe a small market correction? Or is this the beginning of a serious market crash? Let me show you a quick brochure of what we're doing here. I'm going to bring this up for you. So, we look big picture, long term, right? So if you're looking short term, it's gambling. Market goes up, it goes down. Typically 7 or 8 years out of a decade, the market will go up. But we want to make sure that we're protecting the money along the way. Let's see what we have here. There I am, Bill Constane, guaranteeing safe growth and income for retirement. And I'm going to talk about annuities today. I'm going to talk about annuities. The top 5 retirement questions. If you're getting closer to retirement or if you're in retirement, you may not want to have all your money exposed in the stock market. And if you do, might be a nice time to take a little bit off the top. I'm not saying you have to take all the money out, but if you feel strongly like you need every dollar and you don't want to have anything at risk, indexed annuities give you the opportunity to participate in the upside of the market and none of the downside. There's all different flavors. I'm not going to talk to you about a particular product or company today. I want to talk concept. Here are the 5 retirement questions. So if you are 10, 15 years away, especially within 10 years of retirement, 5 years, pay close attention. How will the market affect my retirement? Will I outlive my retirement? How will health costs impact my retirement? Can I get fair returns without risking loss? What will I leave for my loved ones? So I'm going to blow this up here a little bit. Why annuities are the answer for at least some of your portfolio. So here's an example of starting at $100,000. Okay, and this is the minimum guarantee of the contract. Okay, so this is from 1998. This is back tested to 2016. You could see that this is the minimum guarantee. And then here is the actual annuity value, the returns. You could see that it never dipped down. The red is the fluctuations, the ups and downs of the market. Came all the way down here, 2001, 2002. The question is for those that were invested in those years, did you need your money? Not everyone can actually weather the storm of a market correction or crash. So it's great when it's going up, right? But if you need to take money out here, that money will never see the upswing of the market back up. You can't be patient when you require that money for your lifestyle. Something to consider. So again, when you're in the growth stage in your 20s, 30s, and maybe 40s, you can afford to be in the stock market and take a 20, 30, 40% market crash like this, and then like this again, 2 of these here, and not sweat too much if you have the patience to be able to weather the storm. So here is the investor, average investor, and this is without fees, by the way. With fees and taxes, these numbers go down even further. That's the problem. And then the green, that's with the annuity. That's the return that we saw, nice and steady. Okay, and this brought us up to over 223,000. This came up to 196, but you didn't have all the downside. The annuity value represents 123% return locked in gains. In other words, once you're at any of these gains, say you're here and the market goes down, I'll bring you here, and this market went down, notice that it stayed the same. That's called zero is your hero. So here it is, zero is your hero. The market went up just a little bit. So then, okay, actually we had the same here, 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 and then went up a little bit, up again. And here we're trying to climb from the abyss of a stock market correction or crash, depending on what we see. The question is, will it happen again? We haven't seen a market crash in quite a while, maybe 9 or 10 years, depending on what you term as a crash. But can you afford to lose any money, especially can you lose 20, 30, 40%? Will you be the person, the man or the woman, that will panic sell and then really take a loss? Or do you just need money, for retirement? You just can't afford it to weather that storm. Be smart, get with your advisor and ask, how can I diversify? If I'm your advisor, give me a call. If you don't have one or you need a second opinion, someone that really understands annuities, understands retirement income, and understands that there is a whole bunch of companies that are out there that are fighting for your business. And I'm always going to put the client first. We represent over 50 different annuity companies, over 50 different life insurance companies. And we always put the client first. There's not one life insurance or one annuity product for everyone. It's not a one size fits all. But if this makes sense to you, right, would you rather be the red or the green? See, the blue is no gain at all. Every single year, if the market went down, this is the worst that this client would have done. But of course, the market does go up, even in bad times, and this is what we had. If you like that and you want to learn more, safer than the market, the BUF Graph represents actual data. Never outlive your money. Annuities and stocks mix is a proven plan. A former professor of finance at Yale University, Roger G. Ibbotson, who founded Ibbotson Associates, released a statistical financial study in which they compared with mathematical algorithms which retirement approach allowed the longest returns, assuming a 4% annual withdrawal. The results were clear that a 50-50 weighted annuity and stocks to bonds mix was the best approach for retirement. Now, even better, especially when the market goes down, of course, you want to have maybe even a little bit more towards annuities if you're more conservative. But look at this, how a 65-year-old who spends 4%. Now, you might be watching this, you might be 65 or close to it, or maybe past it. You might be 60 or 55, 5, 10, 15 years away from that and saying, you know what? Maybe I need to start positioning myself ahead of time. I can't tell you how many times I speak to people that are already 65 or 70 and they say, I wish I knew you 10, 20 years ago. So you don't have to wait till you're 65 or 70 to get this right. Matter of fact, if you get it right earlier, you can avoid a lot of pain. So here we are, 25% in annuity and 75% stocks and bonds. You have about an 82% chance that odds that your money will last. Okay, the blue is the worst, and that is 100% in stocks and bonds. The blue, no annuities, the worst chance, according to Ibbotson Associates. The odds that your money will last, 50-50. There's the gold, and that 95% chance. If you want to figure it out and ladder it with multiple annuities, we can do a report for you. We can help you find money, increase cash flow, decrease risk, decrease or eliminate fees, amazingly, and increase your retirement income on a guaranteed basis. So with that said, yes, we had a tough day in the marketplace, but just a friendly reminder, hey, markets do go down. They don't always go up, and sometimes they go down in the absolute wrong time. So if all that makes sense for you to consider some diversification, just like you should have some tax diversification, asset diversification, how much of your money do you want guaranteed when you're retired? 0%, 10%, 50%, 100%? That's up to you. But it starts with an initial consultation. So go ahead and click the link in the description. I'm going to leave a phone number this time. You can set up a time to speak with me or one of my agents that works with me directly. Be happy to help you. Please make sure to subscribe, hit that notification bell. Don't miss future videos. And we care about you. We put you first. God bless you and your family, and we'll see you in the next video. Bye for now.